Welcome to PIMCO Pod. In this episode, we discuss how underneath the AI-related optimism lifting stock markets are increasing signs that the cost of tariffs is building. Stay tuned after the conclusion of the podcast for additional important information. Tariffs Test AI-Driven Expansion by Tiffany Wilding. Tensions among three macro forces, trade frictions, the artificial intelligence, AI boom, and challenges to institutions, including the Federal Reserve, were the topics of both our recent cyclical outlook, Tariffs, Technology, and Transition, and a related webcast. In the wake of our Outlook publication, a question we've been hearing from clients in response to equity markets hitting all-time highs and upgrades to global GDP forecasts, including upgrades this week to global growth by the International Monetary Fund, is this: do tariffs really matter? An acceleration in investment in AI and related technologies this year has lifted equities, business sentiment, and wealthier consumers who have benefited from equity market gains. It has also accelerated trade with countries that manufacture computers and components, such as Taiwan. Tech-related CapEx also contributed strongly to U.S. growth in the first half of 2025. However, under all of the AI-related optimism are increasing signs that the cost of tariffs is building. Consider the following. First, the U.S. Treasury's daily cash statement shows that someone is paying the additional levies. Treasury cash collections have amounted to around $350 billion to $370 billion annualized, roughly 1.1% to 1.2% of U.S. GDP on a monthly run rate basis. Some of that is recycled back into the economy through business capex tax and household overtime tax breaks. Indeed, in this same daily Treasury report, we can see that corporate income tax paid has declined notably relative to the same time last year, consistent with companies taking advantage of new tax incentives and tariffs weighing on profits. However, not every household or every business will be affected equally by tariff policies. Lower and middle-income households who don't hold stocks and are exposed to the lower real income growth from higher prices and slow labor market activity will likely feel larger headwinds, as will smaller and middle-market businesses with lower margins that are exposed to trade sectors. Second, although foreign exporters initially benefited from tariffs, expectations of tariffs initially boosted global trade and industrial production and raised global goods price inflation on net. Those effects appear to be fading, with possible payback ahead. While it's still early, various indicators suggest that the costs of tariffs are starting to become more visible. High-frequency data from the Port of Los Angeles has recently started contracting after two large waves of accelerated trade volumes earlier this year. The first wave was in the first quarter ahead of the early April announcements, and the second wave peaked in late June and early July, ahead of the initial July reciprocal tariff deadlines, which were eventually delayed to early August. Since the peak, port activity has fallen relative to last year, according to the same port data. August data on gross U.S. trade with countries in Asia, outside of Japan and China, also show a cooling. U.S. trade with China is down notably this year, but broader gross trade flows throughout Asia follow a similar pattern as shipping data. Gross trade flows initially picked up as U.S. importers raced to build inventory ahead of tariffs, but also as China diverted trade that previously went straight to the U.S. through other Asian countries. September data have been more mixed. China trade data were stronger than expected, but that could have been holiday-related, while Taiwanese exports, which have also benefited from accelerated tech investment, are now down 5% versus their July peak. Weak August industrial production reports from Germany and Mexico, among others, are adding to the evidence that global growth is cooling. While official industrial production data in the U.S. has not been released due to the government shutdown, October ISM manufacturing survey commentary was consistent with tariff costs hampering U.S. manufacturing. Also, global energy prices have fallen after spikes at the beginning of the year and in June. Copper, which has historically been an indicator of global cyclical swings, is down after peaking earlier in October. In the U.S., credit spreads, especially in high yield, are wider, while equities of business development companies, BDCs, are down notably, consistent with our concerns that smaller and middle-market businesses are more exposed to higher tariff costs. Taken together, these data points start to paint a picture consistent with our outlook for some near-term global cyclical growth deceleration as tariff-related adjustments begin to take hold. In other words, evidence is accumulating that tariffs do matter. Will tariffs derail the AI investment boom? That's a thornier question. Businesses' need to adjust to tariffs could provide the incentive to accelerate investments in cost-saving technologies such as AI, at least in the near term. How much AI eventually saves and its broader implications for labor markets, households, and the economy remain open questions. Regardless, we do think tariffs matter. Tariffs initially led to a temporary acceleration in activity, a trend that now appears to be reversing, while a bigger disruption to the global supply chain and to trade network builds. The initial impacts of tariff policy may appear more muted than many expected, but global trade and industrial production weakness could continue, becoming a clearer focus for investors despite the optimism from ongoing AI development. The latest market reaction to rising trade tensions between the U.S. and China is a case in point. Thank you for listening. That was Tariffs Test AI-Driven Expansion. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.